There are three things that really caught my attention when it comes to Torm. One, it is the biggest portfolio position for Howard Marks. Two, it has an unbelievable dividend. And three, its stock is at a 52-week low. So today we are going to go through our 7-step analysis process to find out why Marks has such a high conviction in this company. Is this dividend really as great as it seems, or is it a trap? And we will also find out, should this be our next big investment? Torm is a shipping company specializing in the transportation of refined oil products. It operates one of the largest fleets of product tankers in the world, making it a critical player in global energy logistics. This is going to be interesting. Let's dig in. Imagine you invested $1,000 in this company in February 2018, when it entered the US stock market. That initial investment would have bought you 132 shares. Fast forward to today, and those same shares would now be worth approximately $2,467. But this company doesn't just grow in value, it also rewards shareholders with dividends. So since 2018, you would get $1,164 as dividends. If we add together the current value of shares and the dividends, we get $3,631. And that is a gain of 263% since 2018. I have to say, that is not a bad return. So let's see who benefited from it. Individual insiders, that is an X. Less than 0.1% of the company is owned by individual insiders. So unfortunately, the management does not have its skin in the game. And are individual insiders buying? That is an X. We only see a number of sale transactions recently. And the super investors own this company. That is a check with one super investor, and it is, of course, Howard Marks. It is his biggest position, making up 26% of his US portfolio. And his fund owns 41.7% of the entire company. And is he buying right now? That is an X. He reduced his position by 8%, which is equivalent to around 3.5 million shares. So let's try to find out, what does he see in this company? Return on invested capital, that is an X at 2.9% 10-year median returns. And we want to see this number higher than 10%, so that is very disappointing. And what do we know about net profit margin? It is a check averaging 22.1% over 5 years, and the sector median is 12%. So that shows a really strong position of this company. And now let's take a look at share buyback. It is an X. They issued extra 87.6% of shares since 2015, when they went through a restructuring process. So they are diluting long-term investors in a very meaningful way. And the debt? It is a check. It would take less than 2 years to pay the long-term debt with a current free cash flow. So that is fine, but unfortunately the whole financial health is a bit of a mixed situation. But it is only a part of the story. We want our companies to be strong, but we also want to see them grow. Revenue growth, that is an X at 4.4% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so not too good. Free cash flow growth, this is a check at 11.1% in the last 10 years. And also here we like to see this number higher than 10%. And earnings per share growth, that is another check at 15% since the restructuring of the company in 2015. Before that time, we can't really calculate it because they were losing money. So growth is decent, but Torm is definitely not a growth stock. Its value lies mainly in dividends. The dividend yield is 31.3%, so shareholders got $5.86 last year per every share. That is an incredible yield. But how secure is this dividend? Well, let's look at the payout ratio. That is an X at 79.1%, and we want to see the payout ratio somewhere between 20 and 50%. What it means is that shareholders get over 79% of earnings as dividends. That is a lot, and the downside to such a situation is that the company is left with not a lot of cash for growth. But actually, Torm has a very interesting dividend policy. The company is committed to distributing 100% of free cash after debt repayments on a quarterly basis. So they take care of the investments and payments they have to make and just give out the rest as dividends. And what about dividend growth? It is an X. Because of the dividend policy, the actual dividend changes all the time. It goes up and down every quarter, so we can't really predict its growth. And even if a company pays out a great dividend, we should consider buying it only if the price is right. Price to earnings ratio is just 2.5. That is crazy. We basically have to pay only $2.50 for every dollar this company earns. But PE ratio can be sometimes misleading. So let's calculate the intrinsic value of this company using a discounted cash flow analysis. And we will use a 5-year average free cash flow because it is a cyclical industry, and that way we can get a more realistic view of the company in the long term. So in the low scenario, we will estimate a decline of 5% for the first 5 years and then no growth. In the medium, no growth for the entire 10 years. And in the high scenario, 2% and then 3% growth. So the low scenario is showing a story in which we see a number of problems for Torm. Medium is predicting a stagnation, and the high one is close to the predicted growth of the industry, which is 3.5%. So it seems that we are rather conservative with those assumptions, and that is exactly what we want. Predicting a huge growth and then saying, wow, this company is cheap, is a very easy way to disaster. So with such estimates, the intrinsic value in the low scenario is $19, in the medium $25, and in the high scenario $31. But we have to always apply a margin of safety to those prices. I use a 30% one, and with such a margin we get in the low scenario $13, in the medium $17, and in the high one $21. And the current price is around $18, so Torm seems to be fairly valued currently. But before we make any investment decisions, let's try to take a bird's eye view of this company. So what do we know about Torm? It has a big dividend that may change at any moment, and it is fairly valued. On the other hand, we see a number of headwinds. Geopolitical tension in the Middle East have led to vessel rerouting, and that can create uncertainty and volatility. Also, EU sanctions on oil trade between the EU and Russia are affecting trade routes and demand for shipping services. They are also diluting long-term investors by issuing a lot of new shares. And it is a very cyclical industry, so we have to take that into consideration and decide, is such a company a right fit for our investment strategy? Now let's open our Stock Ranking Pro and see how Torm compares with other companies we analyzed on this channel. So it is a 28th cheapest company in the ranking, so that is nice. But when we look at the quality of the company, we can start to have few question marks. Overall score of the company is just 1.4, so it is well down in the bottom half of the ranking, and when we open the overview, we see that there is nothing really bad about this company, but also there is nothing exceptional about it either. So it is not a great company at a fair price, but rather a fair company at a fair price. But you can also be betting on the huge dividends to continue, and then it starts to look much more appealing. Thanks for watching and see you in the next one.